Today we're going to be looking at Boeing stock from a value investing fundamental analysis point of view. So we're not going to be looking at a lot of technicals or anything like that, but we are going to try to dig into its financial statements, try to identify any trends in the numbers to determine whether Boeing is a good investment or not. I'm doing this video as a request from one of the people that commented on one of my shorts. His name is Jade, and it's my second video I'm doing by request. That to say, if you have any ideas, anything you want to see, definitely put that in the comments for me, because I want to address those. This channel's hopefully to help other people to do this kind of work for themselves. Definitely don't take my word for things. I'm not giving investment advice. I'm just hoping to kind of pass along some of the tools and means that I use when I'm looking at companies. Typically, I'll read through the annual reports. Unfortunately, with Boeing, as I look through the numbers, I kind of developed a defined picture for myself before needing to really dig into the financial reports. So typically, I'll do that. Occasionally, I'll do comparisons. I do like doing those. So I've looked at GM and Ford. I've looked at Coke and Pepsi. And then the other video I've done by request was for one of my subscribers, Toasty, and that was analyzing Disney stock. So you can check that out. That was my last video I uploaded. So today we're looking at Boeing. Something different I wanted to do, since this is not a comparison, is to look at 5 years of information to identify trends. I think that's important when you're looking at Boeing stock, because when you just look at a individual situation, just a snapshot of the current moment, I don't think you're getting the full picture. And so we're going to look at some trends. All of the information that I'm providing in here can be found for free online. All of the currents, so anything that just has one column worth of information, those are out of Yahoo Finance. Anything that's got 5 years, that is pretty much from Seeking Alpha. You can get 5 years worth of information from Seeking Alpha for free. If you want up to 10, I'm sure they have paid subscriptions and all of that. I'm cheap, so I don't like to pay for it. And that to say, this is my second time recording this. I recorded the whole thing earlier, came out at like 16 minutes, and uploaded it, and sure enough, I did it without any sound on. So sound checks are important, and we're going to dive in now. So this information is for fiscal year ending in December of 2022. So, of course, there's been current information. We're almost into second quarter of the year. So, definitely dig into that to see how the situation is. But I'm focusing, again, on annual trends. So the first thing I like to look at when I'm looking at a stock is the ISS Governance scores. That's kind of a personal preference, but it kind of gives me an idea of the nature of the company. And as you'll see, they don't necessarily tell you everything you need to know, because right here, Boeing stock, the company looks pretty good from that standpoint. It's a scale of 1 to 10, 1 being the best, 10 being the worst. So, on their board score, they have a 1. They've got a great board. On compensation, they've got a 10, which is not good. They way overpay their executives. And come in right in the middle on audit and shareholder rights, which is positive. A lot of companies don't come in very positively on shareholder rights. Unfortunately, as we continue to go through Boeing, this is some of the last really positive news. So I do apologize to Jade. I know he was really excited to look at Boeing. But truth be told, as I dug into it, I didn't find a lot of positive things personally. And maybe it's because I don't fully understand the aerospace defense industry, or I'm just looking at it through a negative light. So, if you're seeing something different than me, definitely make sure that's in the comments as well. I do not mind being corrected at all. I want to get better as someone who studies companies as well. So definitely help me out while I'm making these. So I had noted in a short video yesterday that there's 3 really important areas to look at when you're evaluating a company. The first is working capital. Cash is the lifeblood of a company. You want to make sure that it can meet its liabilities, that it's solvent, it's got liquid assets, and then it can stay in business. If it can't pay its debt, the business doesn't stay in business. It's that simple. Next, you want to look at capitalization, and that's just the big word for how is the company funded? How much debt does the company have? What is the ratio of their debt to their equity? Those are important things to know because if they're funding cash through debt, then that's not sustainable. And last is profitability. I've got things kind of mixed up here, so I've got profitability kind of up here at the beginning, but we're going to see some more important information on this later on as well. So this is from Yahoo Finance. It's just a snapshot. Profit margin being negative 5.86, and then operating margin and return on assets being extremely thin. I like to see double digits on any margin or returns that a company is operating under. Maybe that's personal preference or asking too much, but that's just where I like to see things. That tells me that the management is being effective in how they're using their resources, and they're keeping expenses down while increasing revenues. Return on equity comes up as an NA. The reason Yahoo does that is when equity is severely negative, the percentage just doesn't even make sense at that point, and that's something we're going to see here on the balance sheet. I wanted to compare current price with the price history. Current price is sitting at, it was around $219 earlier today when I first recorded the video. I believe it opened around $218. And then on price history, we can kind of see, and we're going to see this through all the numbers really, is a decline from 2018 to the present. So it was up at 327 back in 2018. It's declined into, bounced a little, 332 down to 214, 201, 190s. Today it's up a little bit, but still part of that downward trend in price. And so, if you bought stock in 2018, good chance, I would consider it being overpaid for the stock because it's not panning out. Part of that has to do with some of the situational things that happened, especially throughout the course of 2019 into 2020. The Boeing 737 MAX issues with the construction of those and getting those to their clients was a big issue. There were some design flaws and investigations going on to those. They ended up with hangars that had half-finished planes or planes they couldn't ship out just sitting there, getting old. So that's a big problem when your big sales are through large pieces of inventory. As far as earnings per share goes, we can see that the share price does track along with the decline in earnings per share. It was all the way up at 17.85 in 2018, decreased to -1, -20, down to -7 and -8. So it seems like it's kind of just bottomed out at this point. Price earnings moving forward, Yahoo had it listed at 2.00K. I believe it is trending towards around 200 times earnings. This is insane for a company that's been in the situation it's in. And maybe I needed to read the annual report to see what big projects they're working on. But one of the things that I noted in that short video as well, besides the way of evaluating the company, is that annual reports really serve two purposes. One is to give important financial information, though the problem with that is you can't really understand the financial information just by looking at it. You have to dig into footnotes to understand how the accounting was actually done, what might be left out, off balance sheet items, those kinds of things that would affect it. And then also it's a PR statement. The letter from the CEO to the shareholders is usually written by the PR department, not the CEO. A lot of the things, materials given, charts and things are meant to sway you to either hold the investment or to buy more. It's a lot of marketing material that are in those. So you really have to take a lot of things with a grain of salt, try to see through some of those issues and those things that they're trying to pitch. And so that being said, that's why we're looking at the numbers here. So trailing PE, it said not available. Again, it was negative. They don't like putting negative numbers on Yahoo Finance. The PEG ratio, this one looks at the price to earnings growth. So looking at how much you're paying based on what it's projected to grow to, and that is 6.53. Ideally, you would see less than 1, maybe around 1.5. Below 2 is acceptable. So 6.53, that tells me that people are overpaying for the stock currently. It's not going to grow enough to justify the types of earnings growth we're going to see. Price per book is negative, and the reason for that is it has negative book value per share. That's that next row. So it was 60 cents back in 2018, and then it's been negative ever since, negative $15, negative $31, negative $25, negative $26. So there's not enough tangible assets that Boeing has on hand on its balance sheet to justify the price that it's trading at. And then price per sales is actually, it's positive. 1.84 is a respectable price per sales. Some tech companies, especially in the startup growth phase, trade at 100 times price per sales, so 1.84, I can live with that. Now, as far as getting into the profitability metrics, something we want to see in any company is that revenues are growing, and along with that, that expenses are either staying the same or decreasing, so that operating margin should either decrease or stay roughly the same. I mean, ideally, again, operating margin would be growing. Problem here is when we look at 5 years worth of data, revenues pretty much declining. They kind of flatline there around 2020, just not getting better. Again, you want to see some kind of increase. It doesn't have to be the same percentage every year. That's not sustainable, but it does need to be some kind of increase, or just in the same ballpark, really. You shouldn't be going from $101 billion in revenue down to $58 billion in revenue. With that, then operating margin has gone negative. It went from 11 billion down into negative 2.1, negative 8.4. That's a really bad sign profitability-wise, because they're spending more just to run the business than they're actually making on the business. I take these growth estimates with a huge grain of salt. It's just a bunch of analysts compiled together on Yahoo Finance, but I look at it because I like to see what other people think. So past 5 years has gone negative 31.46%. That's a past factual number, but on next 5 years worth of growth is being booked at 93.8%. Maybe they're seeing something I'm not. Maybe the annual report really painted things as being really rosy and they've got some big projects on the horizon. I'm not sure how you get there with their current financial situation. As far as cash flow, it looks like they have $6.41 billion in operating and $7.13 billion in levered. That might be a promising positive sign in the sense that they can pay to run the business, they can pay down debt, even with their current debt levels. I'm not sure I really trust those numbers. I'd want to dig more into the cash flow statement if it was me. Looking at the current ratio, it's remained roughly in the same area, right around the 1s to 1.3 range. Ideally, you have 2+, 2.5 is kind of where I really like to see things. And so part of me wonders, how would they be keeping their current ratio the same when, the revenues are declining, their operating margins declining. You look at the quick ratio, it's the same as the acid test. It just looks at liquidity. So it's your current assets minus your inventory divided by your current liabilities. This really needs to be at 1. Because it ensures that you've got enough cash on hand to actually pay your bills throughout the next 12 months. Well, they've been sitting at right around 0.3 or so for the last 5 years. So they've got a third of the cash on hand they need to be able to meet their current liabilities. The reason for this is because like 60 to 70% of their current assets are sitting in inventory. And one of the troubles with a company like Boeing is their inventory is giant planes primarily. They also operate in the defense sector, and I think they've got some space-related things, but a big part of their revenues comes from selling large airplanes. And so when you've got $78 billion worth of inventory sitting on there, you really want to discount that out, because how long does it take to sell a plane? How long does it take to fill those orders? And it's really cluttering their current assets currently. Next thing I want to look at is debt to equity. This is that capitalization area of evaluation. And when I'm wondering how they keep their current ratio the same, the debt to equity and the long-term debt levels really give us a picture of how that's happening. So it was at 33.77, which is a pretty good place back in 2018. Well, it goes negative, and that's not because they had a negative amount of debt, because debt to equity is your total debt divided by shareholder equity. The reason those numbers are negative is because they have negative equity on the books. So negative 3.44, negative 3.59, negative 4, negative 3. It's a terrible place to be at for a company like this. That means that they've been taking on more and more debt, and essentially that's floating their current cash situation. So not really a sustainable place. It's been sitting around the same place as far as debt to equity, not a positive sign. The other issue there, when you look at long-term debt, they went from $8.5 billion all the way up to almost $61 billion by 2020 from 2018. Yes, they've paid some of that down in the last couple of years and not taken as much, but they're sitting at a really tight in a really tight spot to have to navigate that. One of the results of that debt situation is back into 2020, beginning of 2021, they suspended their dividend. When a company suspends their dividend and they're not turning around and really focusing on growing the business, growing revenues, research and development, those kinds of things, when they stop it because their financial situation has gotten to a really bad spot, it's deteriorated to the point that you have to cut your dividend, that's a sign that there is big trouble going on in the company. So the fact that they don't offer a dividend anymore when they did for a long time tells me that something's not quite right at Boeing. There's a little bit of insider ownership, which is great, but again, I feel like I've seen a lot of what I don't want to see here. And then finally, jumping into their competitors, you've got Lockheed Martin, General Dynamics, Northrop Grumman, Airbus, Raytheon, Embraer, Bombardier, and Safran SA. The thing about all of these companies who operate in the aerospace and defense industries is they all pay dividends, they all have a positive book value per share, they all have less debt than Boeing does, and they all have higher gross profit or gross margin along with net income than Boeing does. There is one, Safran does have a negative gross margin or gross profit, I believe, but it's $2 billion less of a deficit than Boeing has. So any of these competitors look better from a number standpoint than Boeing does currently, and part of that's just a difference in maybe their revenue mix and different things. But if I'm trying to compare it to the industry, Boeing doesn't come away looking great. Of course, as I mentioned at the beginning of this video, I'm not giving investment advice. If you see something in Boeing, you've read the annual report, you really see a turnaround going on, by all means, you go ahead. I just feel like personally, as a value investor, as someone who adheres to fundamental analysis before jumping in, maybe Boeing's a good stock, maybe there's good things going on, but I think there are other healthier companies that would be a good spot to park my money at to hopefully get a better return. Maybe Boeing in the next couple of years goes up, 900%, makes a lot of people rich, but also, it's in deep debt territory, so maybe it just gets worse. And it's not really a game that I want to play, but again, do the research, dig in, and just try to invest well. I'm not going to tell you what to do. You can only do that for yourself. So definitely let me know what you think in the comments. Like and subscribe if you want to see more videos like this. And again, comment and let me know if I see something wrong. Let me know if you agree. I want to get better at this. I want to be able to really provide quality information in what I'm sharing on my channel. So just let me know, and I'm going to keep improving, keep getting better, and I will see you next time.